Okay, good morning, everyone, and welcome to the Financial Juice news stream. I'm your host, Tony. So I just wanted to start off the day. Of course, we have news coming out from the USA, hence the title called Trump versus Xi again. So Trump continues to try and mount pressure on China for hiding the full extent of the coronavirus outbreak within China. US futures also had an impact as well, as did oil, and we'll go through that in a bit more detail. So the first sort of headline, the Trump administration is pushing to rip global supply chains from China. Now, what's happening here is that the US is working with other nations to create a more forward-looking and more advanced global economy, technically, right? So here, the US government is working with Australia, Japan, India, New Zealand, South Korea, and Vietnam to move the global economy forward, according to Pompeo, which is what he said on April 29th. Now, what does that mean? That means that there's, again, this friction being built up between the USA and China, where the USA doesn't want to rely on China so much, looking forward ahead into the future. That's one of the ways you could take what the USA is doing at the moment. Also, one of the other ways you can take this is that the US doesn't want to be dominated by China either. So that's another viewpoint of where the USA could be viewed as being embarrassed or being put under a lot more pressure or undue pressure that they don't want if the US is superseded or overtaken by China. Market-wise, we'll go through that in a little bit. We'll just show what's going on. But also, this is if we're talking about how much this is going to impact markets. Let's bring up this article or this chart here on the ES. Okay, so we can see that today we open up lower on US futures. This just shows you what's happened in the past. But if we have a look here, so if we just see the full movement, so from last night, where do we sit? So we did have over a 1.5 percentage point movement towards the downside, which isn't too much. Again, there is some negativity coming in from the US having new frictions caused by between the US and China over the coronavirus outbreak handling and sharing of intelligence, and also the USA looking to look to other countries to work together with to create a future economy. So this is one of the things that we just got to keep an eye out for as to how this moves forward. But global markets did drop a little bit as they were spooked by China-US tensions over the virus, right? So again, Trump, you've got to remember, in the USA, the number of coronavirus cases had skyrocketed to become the largest globally. Also, with the number of deaths as well, looking to which is the highest as well within the world. It's a way from, so one point of view is that Trump is using China and their quotation marks incompetence of dealing with the coronavirus to distract from how badly that the US has been handling the coronavirus. Don't forget, we have non-farm payrolls this Friday. Okay, now non-farm payrolls, the minimum number or the forecast figure for non-farm payrolls is over 20,000 K, so over a 20 million K in the number of jobs being lost, right? So that's one thing that's going to be the key sticking point for the US this month. which is going to have an effect economically. Market wise, we'll look out for reactions, and we'll discuss that a little bit further as we get towards the Friday. But that's one of the reasons as to why why we're seeing Trump pushing towards China being the cause for all of the US's problems, right? We've had this narrative going on for quite a long time now, and it's quite obvious to see what's going on. And if you're not seeing that at this point, then you've got to just go through the news and just see what's happened in the past. So that's that bit of news there. Also from Euro GDP, also I'll bring up a little image for you guys to see as well with me. One interesting thing I found, this is going to be likely going to show how the rest of Europe is going to handle the effects of the coronavirus. So here, if I just zoom in on here for you guys, let's bring that up. Okay, so Euro GDP, the first slew of GDP data released this week demonstrates the trade-off between prioritizing the health of the economy and that of a country's citizens, with those countries that have enacted more restrictive measures such as Spain, France, and Italy, that are suffering large economic contractions in activity. So this is by year, as we can see here. So this is the global financial crisis, where we've seen a huge dip in overall GDP. 2020. This is for the euro as a whole. This shows quite a huge dip for Spain, France, and Italy. So these southern nations within Europe, which have taken these stringent measures, are seeing these huge hits. Now, the reason why I'm showing this, okay, is that I just want you to have an understanding as to what could be the potential impact for other nations within Europe, the bigger economies. So you've got the UK, and you've also got Germany that you also want to look out for, right? How badly will it affect their results for GDP? Now, before we talk about Germany's GDP, one of the data that has come out so far is that Germany's market manufacturing PMI came out higher than expected. So the forecast for their market manufacturing PMI was 34.4, and the actual came out at 34.5, which is a positive sign that Germany is keeping hold of its economy and trying its best to keep everything up number-wise from last month's data. But what's going to be interesting is, so one of the interesting things is also from the Eurozone market manufacturing PMI, which came out 5 minutes later. So we've had from the Eurozone market manufacturing PMI, 33.6 was the forecast, and the actual came out at 33.4, which again, so the Eurozone as a whole showing not to be so strong as Germany itself. But you've got to remember, Germany being one country, you've got to take in the fact that the Eurozone or the European Union is taking in the fact of 28 countries, or if you're going to exclude the UK, 27 then. So you're going to see quite a huge effect on the GDP of these nations, and which could look similar to this sort of reaction here of other nations within the Eurozone. If we take a look at the Euro USD, see where we currently sit at the moment, a lot of it's been quite choppy in the markets. Also a lot of the data that we've seen that printed has been what we can see here. A lot of it has been priced in for negative reactions. First of all, you've had negative reactions of when the euro was, or of when the euro saw the first cases of coronavirus taking a huge grip over Italy, and then the rest of the world as well. A movement away from your local currency, the euro, to other cash king currencies such as the dollar. Not seeing too much movement as of yet. We can see some strengthening here, but not again. If we bring it up on a higher time frame, we're trading in within a bit of a range at 1.10 to around this area here at 1.07. So not we are just seeing a bit of a a wave here at the moment, just a range here. Again, market expectation wise, that's something I'll leave for you guys to make that decision on, and you have your own opinion on that. Now, if we're talking about other UK nations and coronavirus and bringing about the end of the lockdown, so this is one of the other things that I want to show you from the Guardian article. What it says here. Let's bring it up for you here. So from the Guardian article, what it says is that, if we bring it up here, so Boris Johnson is preparing to set out on Sunday how restrictions can be eased, but before that, business groups and trade unions have been sent the draft guidelines for how to protect people if physical distancing rules cannot be adhered to. So this is one of the ways that the UK is trying to bring about the end of the social distancing measures, or the lockdown measures, more so than the social distancing measures. But again, for a lot of countries, staying in lockdown and not having businesses run is obviously having an impact on countries' GDP. As I showed you in the previous image, we've seen those huge declines. So again, this is something that the UK wants to try and stop or dampen the hit, or soften the blow to the UK's economy as much as they can. So employees could return with physical shields to separate them from colleagues. Again, these are ideas that have not been confirmed yet, but this is something that the UK is looking to do. Again, this is we've got to wait to see what other social distancing measures or other ways that the UK government could keep the UK could bring the UK out of lockdowns, other than bringing back businesses with a lot of PPE or personal protective equipment being used, and trying to keep the distance between each worker of 2 meters. It's going to be quite difficult for businesses to adapt if they need to come back to, let's say, a factory, or need to come back to the offices, or wherever they work. Then it's going to be quite difficult. It might be quite difficult for them to get around that, and it will take them quite a bit of time to get used to those new social distancing measures after coming out of a lockdown for nearly 2 months. So again, for the UK, if we took a look at the cable, just for any reactions, of course, the 7th of May is when the UK is supposedly supposed to come out of a nationwide lockdown. But again, it makes more sense for a gradual easing of the lockdown measures rather than everyone coming out at the same time. Otherwise, you just get you'll get a huge wave or second wave of coronavirus cases. So if we just look at the cable here, see the continuation of a down movement towards the downside. If we just took a look at a higher chart, again trading in within a range of 1.26 at around, and then another between 1.26 and 1.22 there at the moment. So not too much aggressive movement, as we can see, compared to all of this volatility that we had back in March, and then towards the end of March again. So news-wise, that is most of the news that we have that I wanted to go through with you. One final bit of news that I do want to go through with you, and I think is quite key to understand if you're a trader within your trading UK economic news. So Deloitte, let's bring that up, this article here. So according to Deloitte, top UK companies expect COVID-19 to cut sales by a fifth. So if we just go back down here, so we just have a look here. Britain's largest companies expect the coronavirus to reduce their sales by more than a fifth this year and are gloomier than during the 2008-2009 financial crisis, according to a survey published today by accountants Deloitte. So what they're expecting is that from here what they're expecting. So CFOs or chief financial officers expect sales to be 22% lower than they had forecast before coronavirus hit Britain. So this is going to be, again, if you're looking at retail sales, a lot of this action or movement has been it's been priced in already with this negative movement. So you're not seeing too much aggressive reaction in the markets. Again, we do sit volatility wise. If we just had a look, volatility at 39.4. So we are seeing a little bit of a pickup in volatility compared to last week when we were sat at our lowest point for the month, for last month at 30.6. But again, market reaction wise from the cable for these economic surveys are as if they're expected to have negative figures. They're expected to see retail sales and sales drop off. So the British government forecasts, let's bring it up back to the article, the British government forecasters published a scenario which showed the economic output falling by more than a third in the second quarter and dropping by 13% over the course of 2020. So again, it's similar to the image that we saw earlier from France, Spain, and Germany, that we can see that the British GDP and also sales as well in Britain are going to be hit quite hard. What are the possible scenarios? So one of the possible scenarios is, or is positive, is that one, we are going to see GDP being hit quite hard within the UK. But let's say that the social distancing measures or the new lockdown measures, as UK companies come back into the fray slowly, then we see that GDP slowly creeps back up. So this is the similar scenario that I'm using for the US, right? The US is slightly different in the way they want to do things, using a tiered, layered version of examining how dangerous or how stringent measures have to be within the US. But in the UK, it's a different story. We don't have a tiered layer of how dangerous the state is, or how safe a state, or how safe a county or town is within the UK. So for the UK, it's just keeping an eye out for the positive case scenario would be you would see companies coming back into the fray. You'd see GDP pick up slightly, be able to start reigniting itself. And the amount of borrowing from these companies will also decrease from the government as well. Remember, you do have £350 billion that the government has given or has provided debt to these companies, right? That they borrow this money that they've got to pay back. So you want to see in a positive case scenario where we get headlines and news of UK companies not borrowing or using up so much of the UK government's funding as time goes on. You want to see a decrease rather than an increase in the amount of borrowing. So that's a positive case scenario there. On the flip side, a negative case scenario is where you do get these companies coming back out of lockdown, but because of not knowing exactly how to bring about effective measures to keep keep workers protected, other than keeping 2 meters apart and using protective shields. If that doesn't work and starts to actually have a negative effect on those companies that have reopened, and you see a second spike in the number of coronavirus cases, let's say in factories or in essential areas, essential businesses, then you're going to, and if we see that second spike, then you're going to see an even larger negative hit on the UK's GDP. Why? Because the UK's GDP will suffer again, where there might be a second lockdown within the UK to curtail the number of coronavirus cases leaping up or rising again. So that's a negative case scenario for the UK that we want to keep an eye out for. Also, the UK, just a reminder that the UK has, or the Bank of England has moved its Bank of England interest rate decision back, instead of midday at around 11 a.m. Eastern time, to 2 a.m. Eastern time. So instead of 7 a.m. Eastern time, it's now back to 2 a.m. Eastern time. So that's just to keep that in the back of your mind there as well. All right. Economic releases. We only have US factory orders month over month. Forecast for that is minus 9.7%. And current is 0% at the moment. So just to keep that in the back of your mind for economic releases. It's going to be quite quiet today, other than US 6-month and 3-month bills auctions as well. Okay, thank you very much for listening. Don't forget to like, share, and subscribe to the Financial Juice channel that you're currently watching this video on. We do appreciate people who are coming on to watch me and then to listen to what I'm saying. So again, thank you very much. And don't forget, with our economic calendar, is that you do get live real-time. Not only do you get live real-time headlines coming out, but also economic releases as well, right? You get that at the same time in real time. There's no delay on these economic releases. So do check out the economic calendar, though. Do we have that covers a 24-hour version? If we're not 24-hour on the squawk, then we're 24-hour on the calendar. Okay, thank you very much. Enjoy the rest of your day. Bye.